You did a lot of flips. How did you scale up that quickly? Like, what did that look like? And then I want to talk about your transition then from flipping to
Sure.
rentals.
The answer is partnerships.
Okay.
And I will preach this tried and true is like having great partners is necessary to scale and grow in this space. If you're trying to do it all by yourself, you'll be able to get a couple deals done, but you're going to be your own bottleneck. So I linked up with a business partner early on. He's still my business partner today. That had some very good systems and processes around the marketing side, and then I brought the sales aspect to it. So he had the marketing, I had the sales, and we came into some new markets for wholesaling and flipping. And then we were able to scale the business up. We had 14 employees. We were doing in 2018, 2019, we were doing 150 deals a year. So it takes a
Wow.
lot of coordination to do that many deals, right? All
Yeah.
the title work, everything. So we had a pretty solid org chart. About 14 employees was kind of our average. Five of them are salespeople. Then we had some transactions, some operations, things like that. Um, so it was really partnerships. I was a one man band for a long time. I guess probably a little less than a year, and I felt that like it was a struggle, and I didn't have the blueprint, and I was just trying to figure it out every single day. And then I found someone that number one had a blueprint. I joined a coaching group and a mastermind, and in that coaching group and mastermind, I found a partner.
Mm.
So there's two lessons there. Number one, a mentor is an investment, not an expense. A coach is an investment, not an expense. And number two, when you pay to get in those rooms, that's where you start to link up with other people that share the same core values, that are pushing in the same direction, that you can then say, hey, you have these complementary strengths. Let's see if we can figure out a way to do this together.
Yeah. And you guys scaled that to a point where most people, I mean, I've talked to a lot of people who want to build a flipping company, and, most people would love to be in that position where they're getting, doing 150 deals a year and have an operation that's all set up. It sounds like you had a good system in place. Why wind that down and switch over to commercial rental properties?
It's a great question. I'll answer it for me because my business partner, his name's Bill Allen. He still has that company rolling. So I actually exited to go to commercial because, if I'm speaking my truth, single family was very, very transactional. Like, it was very much, at the end of the year, we do 150 deals. We're all celebrating at the Christmas party, giving high fives and everything. And then the next year we have to go do it again, right? There's no residual. We just have to go out and do it again. And there's no tax benefits.
Mm.
So like, we're literally paying out the wazoo in taxes for all this active income we made. And then we literally have to go back out and do it. And it was like if you're building that business to sell, or if you're building that business to then give it to like a president or a chief operations officer to run, it can become a very well-oiled machine that you do want to let run. But I was, a major cog in the wheel running the sales department. And I got a little burnt out, to be honest with you. You do 400 transactions, in 3 year time period. It's a lot. So I would rather do, less transactions that are bigger numbers.
Yeah. No, I can totally relate to that. Had a flipping company for 5 years, very similarly, from 2011 to 2016. And it was just a giant hamster wheel, that's when I transitioned to rentals as well. And I didn't realize your former partner is Bill Allen. He was a guest on this show as well. Really sharp
Yeah,
guy. So,
great guy.
yeah. Well, so I guess, can you share a little bit about the difference between what you do now and how do you spend your time in in your day to day, I guess, running a multifamily business compared to the flipping business?
Sure. So we have 120 million right now in assets under management. Most of it's right here in Middle Tennessee. I'm based out of Nashville, and most of our stuff is within a few hour radius of us. So my day to day is spent. I would probably say 50% of the time I'm doing operations for our current portfolio, just optimizing the net operating income on our assets, keeping an eye on our expense line items, keeping an eye on our controllables, our leasing volume, everything. And then the other 50% of the time I spend looking at new opportunities. We are looking at a lot of deals right now in order to buy one. The market is kind of crazy. If you don't know what you're doing,
Yeah.
you got to be really careful right now. There are deals to be had. Hell, we're closing on $43 million in the next 3 weeks. So there's deals to be had. But you have to be really careful. You got to look at a lot of deals to know what a good one is, to understand the basic and economics from them. So I spend a lot of my time behind spreadsheets, the less sexy part of this business that nobody really talks about, right? Because everybody likes the property walks and to take the photos and the selfies outside of the assets, but really you got to fall in love with the spreadsheet, not the property. So I spend a lot of time looking at spreadsheets and underwriting deals, and then the other portion of my time is spent optimizing, the current assets under management, making sure that we're cash flowing well enough to distribute to our investors, and taking care of our tenants, which take care of our properties, which take care of us. So
Got it.
that's my day to day. I'll
Yeah.
break that down a lot further, but
No, that makes sense. Um, so can you kind of share the difference between their first multifamily deal and this one? Because I imagine you didn't start with the $43 million deal. A lot of people hear that and they're like, wow, I could never get into multifamily because I can't put together a $43 million deal. But I imagine you probably started with smaller deals and have worked your way up.
yeah, my first deal was a little 14 unit. It was $750,000. Me and two of my buddies each put up 33% of the capital to close it, and we all guaranteed the loan. I think we put up like 170 grand or something like that. So we all split it and guaranteed the loan. That was my first property. And then my next one that I did, Bill Allen and I went 50-50. It was a little 21 unit property. We paid 950 for it. And then I did it was 21. Then I did a 27 unit. It was $1.2 million. It was a little 27 unit. And then I did, after the 27 unit, we started to realize that we needed some more capital to buy these things without having to slow down our buying velocity. So that's when we did a 506B syndication to buy our first 49 unit.
Mm.
And then we raised like $800,000. It was a $2.5 million purchase. And then we did, after that was a 65 unit. And then we did a 93 unit. And then we've been buying everything in between, 50 and 150 units ever since. So yeah, I definitely understand, now looking back, 6-7 years, it's a journey that has got us to this point where we're now closing on a $32 million deal. But I'll tell you that I've done a $320,000 deal, I've done a $3.2 million deal, and I've done a $32 million deal. And the only difference is a zero, right? It's definitely bigger, but you're dealing with the same thing, just at a bigger scale. So don't get too hung up on the size. And if you understand the operations of it and how it makes money, believe it or not, raising capital for a $32 million deal is actually a lot easier than raising capital for a $3.2 million deal.
Mm.
And that may sound crazy, but it's easier because you're talking to a different person. You're in a different ballpark with a different investor, right? We have one investor writing a $10.5 million check, and that's a lot easier than rounding up, a bunch of people to write $50,000 checks. So
Yeah.
I will tell you that, just don't get caught up. I'm a trial by error person. I have to learn. So I did the whole thing where I scaled up. I did a 14, then a 21, 27, 49, 65, because I had to make sure I could do this, then I can do a bigger one. Now I can do a bigger one. And that was my journey. That's how I chose to do it. And if that's how you see fit, you can do it that way too. But don't shy away from doing a 100-unit deal because you haven't done a 10-unit deal, because that 100-unit deal may be really good.
Yeah, absolutely. What would you say is the biggest lesson that you've learned from scaling up? Like, is there anything that stands out that you're like, well, I wouldn't do, that type of deal again? Or usually it comes from something that was a painful lesson learned, but
Yeah.
it doesn't have to be.
Yeah. I've done 24 commercial properties right now, and there's probably two of them that I probably wouldn't do again.
Okay.
Maybe three, 2 or 3, but that's not bad. I mean, batting 90% is not bad. Like, you're not going to pick all winners, and if you're trying to, like, you're probably never going to do a deal because you're going to be so gun shy on the sidelines. So, I've learned that, if your gut's telling you something, there's a reason, and you should listen to it. Because the only time I've ever gotten, and I've never had to do a capital call. I've never been fortunate enough to never be in that position because we do underwrite very conservatively. But I've had some red flags go off and chose to ignore them, and they end up being true, right? So if your gut's telling you something's off, make sure you dig in and make sure you ask, and just don't confuse your gut of being nervous with something being wrong,
Mm.
right? So that's where it kind of helps out when you have a mentor or a coach by your side, because I I actually canceled the first 3 multifamily properties I had under contract. I canceled those due to my coach's advice.
Mm.
And I didn't know what I didn't know. I could have been way behind the 8 ball stepping in potholes, but my coach, my mentor at the time was able to tell me, hey, you missed this, hey, you didn't account for this. And so I was able to, you know, avoid doing a bad deal. Cause right now, like sometimes the best deal you ever did is the one you didn't do. And people need to be careful right now buying value add deals on bridge debt. People need to be really careful with the type of loans that they're getting on properties and the exit strategy. I think people really don't think too much about the exit. And I have this saying that takeoffs are optional, but landings are mandatory. And you need to really think about when you're going to exit the property, who you're going to exit it to, how much you're going to exit for, and is that a realistic time frame and expectation? Because we get into this wealth conversation and everybody's like, I'm going to buy and hold commercial real estate forever. And I'm going to give it to my grandkids. And that's all good and well. But like, if you have investors, like you can't just tell your investors, hey, I'm going to give this property to my grandkids one day. They're going to be like, screw that. I want my money back. So,
Yeah.
we build businesses to sell, and they have a 5 to 10 year time frame to exit. And then we take those profits and we then roll them into, properties that we, hold for ourselves. But, for the most part, if you're buying with other people's money, like you have to have an exit plan in place. So I would always just, trust the spreadsheets and trust the numbers because they don't lie. And that's my biggest piece of advice is, God, just live and die by the numbers because they do not lie to you. And
Yeah.
if you get your emotions involved with the property, like that's where you end up losing money.